All right, so after a brief technical issue, hopefully, we're back in live. The perks of running things remotely, as we were kind of talking about just now. So getting back into that conversation where people now have the capacity to work online. And so now your students who really grew up in that COVID world, their last 2 years of high school were probably remote, depending on what city they lived in. And now they're coming into college, hopefully back in person, depending on the state. What are their viewpoints, their opinions on entering the workforce, even the markets in general now?
I think that there's certainly a demand for remote work that did not exist 10 years ago, 5 years ago. I think the pandemic proved that certain roles could be done remotely, but not all roles. And I think at not all stages of one's career do you want to necessarily be remote. So if you're a younger employee, the beauty of being in an office is getting the mentorship, getting exposure to senior leaders, getting mentorship and coaching, having a game plan and really developing your career, and also understanding what the competition is like, because you're competing with your peers for promotions and opportunity and so forth. And I think you can put yourself at a disadvantage if you only want to work remotely. I think it sounds great on paper, and I think some people can be super disciplined to be very productive, but I just don't think all roles can be done remotely. I think certainly if someone wants to aspire to be a people manager, for example, being a manager requires sometimes being in person, being face-to-face. And so my advice would be go for the balance role. Go for the role that maybe puts you remotely a couple days a week, but don't be afraid on Tuesday, Wednesday, and Thursday to come into the office if need be. I also think it means maybe not doing a remote role for 2 years and never showing up in the office. Maybe it's a 3-month stint you try remote work, or 6-month stint, but it can cubbyhole you. You can block yourself by doing too much remote work. The good news is we have technology that is mostly proven, but again, it's not perfect. This is a great example. We just had a technical little glitch here. Can you imagine presenting to a customer or to a client and having a technical glitch? It's not seamless, and you can work through that. I think there's more tolerance for it today, but you can work through it a lot easier when you're face-to-face. So what I would say is be cautious about the whole idea of being able to work from anywhere. It may not always be the best.
Yeah, absolutely. And I think that a lot of research by Professor James Aaron Brown, who I hope to have on in the coming future, has also shown that a lot of Gen Zers are actually preferring to get that in-person work experience, especially after having been isolated, for lack of a better term, in the last couple of years, getting that
Sure.
in-person exposure, getting that social experience. And as you mentioned, getting that hands-on mentorship where they can talk to someone, ask questions instead of just shooting off an email or hopping on a Teams meeting, a Zoom meeting, whatever it is, to discuss something, having live feedback. Most young Gen Zers in the workforce or in college right now looking at internships really seems to be what they're looking for. And as you mentioned, the hybrid option seems to be preferred even over the remote option. So, finding that balance. But I think, like you said, people who would more likely prefer a fully remote option are someone who has been in the workforce for maybe a decade, a few years, has a family, wants to spend more time being a parent, wants a better work-life balance, especially if they have young children. So I definitely understand why that remote option has kicked in for more, let's call them mid-level, senior-level, associate-level workers as opposed to entry-level workers.
Right.
I know that a lot of positions now that are entry-level prefer being in person, at least for a couple of months before switching to remote, so they can have that in-person training, so that they can actually walk you through things. They can see how you're reacting, how you're working with the software, the hardware, whatever it is that your job requires. So I really do think that that's an interesting shift that we'll continue to see. But also what remote work has done is it's kind of democratized where people can live. Whereas before, if you wanted a big tech job, you had to live in the Silicon Valley. Now, Google has hubs in Atlanta and Miami and San Francisco, but they'll allow workers to live largely a few hours outside of where they are, maybe in fully remote for software engineers. So there is that allowance a good portion of the time, depending on what industry you're in. And that's been really interesting to watch, as things have developed. And seeing how that's also impacting, tying it into more traditional financial concepts, company revenues and expenditures as a whole. Companies now can cut back on commercial real estate, on office space, and they're able to save on that. And I understand why some companies are now pushing for more work from home hybrid options. So, looking at the current labor force, current state of labor participation in general, do you think that we see a reversion to in-person work like some companies are calling for, where almost demanding people come back to work in the office? Or do you think that we see a balance kind of struck between what happened in 2020, 2021 and what existed before then?
I think it will slowly migrate back to in-person. Look, at the end of the day, Gabe, business is a team sport, and you have to be able to communicate to be on effective teams. And I think the communication, while the technology is good between cell phones and instant messaging and email, it's not perfect. And I think that dialogue, that face-to-face dialogue, just can't be replaced. And I think you find that in business. I think you find that in education. I think you'll find that in medicine. People just want to have the personal touch. After all, we are humans, and that is a uniquely human characteristic, to be around other humans, with our tribe, if you will. And so I don't think we can change millions of years of evolution to say, the way we work will be entirely remote. I think we'll probably migrate, and we'll probably get back to maybe a 70-30 kind of a scenario. 70% of work is done in person, 30% is done remotely. And look, there's going to be some efficiencies by moving to the remote work model. No question. As you said, corporate real estate will be, lower cost. You can arm your employees with a decent computer and some ring lights and a camera and a headset, and, they're off to the races, and they can be anywhere, which means they're going to be more productive, which means you'll have fewer vacation, quote unquote, vacation days, sick days, down days, personal mental health days. All of those things will be net beneficial to the employer. So I think they'll opt for, a 30% remote. I think it would be foolish for any employer to try to demand, after what we know and what we've proven through the pandemic, if they were to demand total in person, I think it would be a failure, to be honest. But I also think the pendulum can swing too far, too remote, you become isolated, and we lose that strategic vision of what we're trying to accomplish when we can't all collaborate together.
Yeah, absolutely. I know that, well, first and foremost, I feel moderately attacked with my little ring light, my headphones, and my microphone.
You're rolling, right?
Feel a little bit attacked. But, addressing that point of isolation, kind of the human touch, I think that is why Gen Zs are preferring more in-person roles, because, we know that what the pandemic did to people's anxiety, their depression, their mental health overall was not a great thing. I know that, looking at surveys that were published in the last month or so, where, as of this point, and this is just because of what's happening now in the economy, a lot of people are putting off, looking at their mental health, getting therapy, talking about it. And this is after what happened during the pandemic, where at this point, roughly 2/3, around 60%, so more like 3/5 of people believe that either they themselves or someone that they know has mental health problems, issues that they should be working towards. And this can range from anxiety, depression, or more severe, issues. And that feeling of isolation during the first year of the pandemic alone, it was estimated that anxiety went up 25% amongst the average person. So that point of isolation, really isn't good for people. And looking at how trends are reversing, how people want to not feel as lonely, how do we reverse that trend of 60%, according to that local CVS Health survey, feeling they have a mental health problem? Well, reducing the isolation is definitely key to it, because as you said, sure, us having a conversation, like this or on instant messaging helps, but it's not a direct replacement for that live human interaction, for that human touch, so to speak. So that's also why when I hear or when I see more stringent proponents of the FIRE movement, we're just like, work from a beach in Bali somewhere, never go to work, never see your coworkers, it's fine. Yeah, unless you're traveling with your immediate family, immediate friends. If it's just you traveling the world for a period of years, never really having that stability and just kind of being alone, I can still imagine that takes a toll on you.
Oh yeah, no question. No question. I think most of what we'll call digital nomads do it for a year or two perhaps, but they go into it maybe looking to stay somewhere longer term. The challenge is not every place you go can you stay long term because of immigration rules and other complexities. Not to mention if you're living in an area that used to be low cost and the cost is rising, it'd be harder to stick around long term. So yeah, that's always a challenge. I think there's a certain individual who can take on those kind of challenges, the expat, if you will, the nomad. But not everybody is able to do that, for lots of reasons. It may be their own personal situation. It may be kids. It may be parents. It may be, other situations, a spouse who's got a career that doesn't want to be left behind. So, yeah, that's certainly not for everyone. The FIRE movement is really all about gaining financial independence. So, in other words, being in a position to be financially able to depend on yourself as opposed to having to have a job for income. And people do it through lots of different ways. They can invest in stocks and earn dividends off of stocks. They can buy real estate and have rental income coming in. They can have a business that essentially they sell and are just getting a dividend from the business. The retire early aspect is harder. And that is, what are you going to retire to? I think that's the thing that no textbook talks about. Every textbook talks about how you get to the finish line, but no textbook says, okay, what does day one of retirement look like? What's your plan? Are you going to go to the gym? Are you going to go play golf? Are you going to go sit on the beach? Are you going to go volunteer in the soup kitchen? What's the plan? And I think that's where a lot of people get maybe a little bit misguided. They don't have a good plan for what do they do next. So the FIRE movement is an interesting one because it's ebbed and flowed over the years, and it's actually become, different categories. There's barista FIRE, where that means you're financially independent, but you have a job because maybe the barista role at Starbucks or you fill in the name of the coffee shop has great benefits package. And, health insurance, if you're below Medicare age, is expensive. Even if you're on an ACA plan, it can be expensive. And so, there's barista FIRE and there's lean FIRE, which is, beans and rice and beans every day, and really living a very low cost lifestyle. There's fat FIRE for people who have really made it in the world, and they're the ones that are, riding the G6 Gulfstream to the next family vacation. And there's everything in between. But there's one common theme, and that is mindfulness about money, mindfulness about there's more to life than just working until you're 65 or 68 or retirement age. There's also an awareness that whatever is going to be there at the end, be it Social Security or your 401k plan through your employer or a pension, is not likely to be enough because, look, inflation's running 8.5% a year right now. When is it going to slow down? Nobody can tell us. And medical care is going up. And, oh, by the way, we're, God willing, living longer. And that means there's more years that we're going to have to spend the money that we saved to keep ourselves alive. And so I think there's a common theme in this FIRE movement around being mindful about money. And you have to start early because it's a long game, not a quick hit. There's very few people who hit FIRE in 10-year time frame. More typically, it's 15 or 20 or 25 or even 30 years. Now, you can imagine you work for 30 years. You started when you're 21. You're 51, and you're like, okay, I'm ready to retire. That doesn't really feel like early retirement because you've worked for 30 years. But compared to someone who works for 45 years, who's retiring at 66, you beat them to the finish line by 15 years. Well, what can you do with 15 years of time? Plenty. So, it's important to be mindful and go in with a plan.
So I think that's really important for a lot of people listening because, we, especially people now who are getting most of their advice from social media. And that was a survey that was released a couple of days ago where 34% of Gen Zers get financial advice from TikTok, 33% get it from YouTube, 24% get financial advice from an actual financial advisor. So you have to imagine that when you're on social media, there's a lot of those very unrealistic lifestyles that are being portrayed. Again, people who are retired at 27, who have a Lamborghini or three in the driveway, who have a 20,000 square foot house, or riding that G6. And it's usually accompanied by someone selling something, selling a course, access to a Discord, whatever it is. And it's unfortunate because it preys on that insecurity that a lot of younger people have of, I want to be there. I want to retire young. I want to retire at 35, 40, after 15, 20 years working. Then I want to enjoy life, whatever enjoying life means. Because like you said, a lot of people don't actually plan out what that next stage of their life looks like. And they get caught up in a lot of these traps. I think that they're getting better at discerning who's being more honest and who's not. But it's still very overwhelming to look at someone looking a life that you want to live and to not feel like you want part of it. That was part of the survey that roughly 50% of Gen Zers admitted to posting on social media to make themselves look more successful than they were in the eyes of their peers. And that number, only 50, that number is estimated to be higher because those same people estimated that 65% of their peers did the same thing. So they're less likely to admit that they're doing it, but more likely to say that someone else is doing it. It's not me. Trust me, I'm not the problem. But that goes back to the point of wanting also that social proof of being successful, of being better than your peers. And that leads us into a lot of very interesting situations where now you have more financial literacy based channels online, on TikTok, on Instagram, Reels, whatever it is. But even there, it doesn't get much further than, let's say, basic advice like invest passively in index funds. Instead of going through actively managed funds or trying to time the market. It might be just a point of being mindful about what your spending is. But that's about as in-depth as the recommendations go. So when the market started going down in May, again in June, there was a lot of anxiety in these media channels where you had people piling in going, well, what do we do? And the only real advice that most of these channels had was, dollar cost average. Keep buying the dip, and the dip keeps dipping by that dip. And it's kind of an endless loop of dollar cost average, keep buying the dip. And from my perspective, while that's better than nothing, while that's better than promoting a false reality, that's not really financial literacy. That's just kind of low-grade investment advice. Buy index funds and dollar cost average. That's okay. It's better than nothing, fine. But we lack that real economic background where we can say, well, should we be buying right now? And that's kind of what I want to pivot to at this next point is, how do we make more advanced or even more moderate financial economic topics digestible for people? Because people now are trying to learn more about finances, trying to be more financially literate. And they're trying to find something that they can consume. So first, step in financial literacy, I think most people would say is, make a budget, be aware of your own expenses, what you spend, what you don't spend. And then from there, invest in passive index funds, not in actively managed funds, because if we're being honest, I think roughly 90 to 95% of actively managed funds and advisors could disappear as an industry tomorrow and the world would be a better place. And that's really just looking off of the most recent S&P indices versus actively managed funds report card, which showed that in 2021 alone, 80% of actively managed funds failed to beat the S&P. And over a 20-year period, 90% failed to do so. And I said 1995 just because, assuming that those funds have fees built in, after we subtract fees, I'm sure that less than 5% can consistently beat the S&P. And that's a problem in of itself that our industry really needs to do better on. But what do we do so that people themselves can make those better educated decisions when markets turn, when recessions might be possibly oncoming? How do they know how to approach things so that they're not just sitting on their hands looking to influencers and personalities and saying, what do we do?
Yeah, so that's a good question. It's a bit of a leading question. Investing is actually fairly simple. It's so simple, in fact, that if I couldn't sit down and explain it to my grandmother and have my grandmother understand it, it's too complicated a strategy for 99% of investors. Look, the old adage, time in the market is better than timing the market, still rings true. The data that you cite, 95% of actively managed funds over a 5-year period underperform the S&P 500? Look, we can all get a dartboard and pick a winning stock and buy it tomorrow, and 2 weeks later it goes up and we sell and we make some money and we think we're hot shit. But the reality is, over the long term, Warren Buffett, the richest guy in the investing world that I know, has great advice, which is go buy an index fund, stick it under your pillow, and 40 years later, look at it. It's not bad advice. It's not sexy. It's not cool. It's not a whole bunch of stuff to talk about. And I think part of what has misled millennials and younger Gen Z is that we had a pandemic and there wasn't anything to do because there wasn't any sports to go bet on. And so people started talking about the stock market. It was like the only casino that was open. And so they treated it like a casino. And at the same time, you had apps that were created by companies who were making a commission from front-running stock trades. And that company sensationalized trading, turned it into a bit of a casino effect. And what doesn't appeal to 20-somethings than the excitement of a casino? It's fantastic psychologically. But the reality is, over the long run, that's not investing. It's speculating. There is nothing wrong with speculating. People can make money speculating. But if you want to be an investor, it's simple. You put a certain percentage of your income away, and the more you put away, the more likely you will be to have a whole lot at the end. And you put that into the market, which is essentially owning a piece of every company in the world. And I say the world because you can buy a U.S. index, but at least 2/3 of those companies have global business. So we're betting on the world and capitalism to persevere. And you do that over the long horizon, and you're going to do very well. You're going to do better than most people, because most people, it's not that they're bad investors. It's that they lack discipline to implement that simple strategy of put 20% of your money away every single month into the S&P 500 index and do it over 30 years. If people would just do that, they would be freaking rich, Gabe. They would be freaking rich. And they just don't have the discipline. Or they think it has to be complex. They're messing around with crypto, and they're messing around with options, and they're messing around with different derivatives and leveraged exchange-traded funds, and they're timing the market, and they're applying all these theories. And if you're a trader, that's a very, very niche part of the financial market. Maybe 2% of people in the world are traders. The rest are investors, and we've got jobs to do and kids to take care of and homes to build and yards to mow, and you can't be distracted by all the noise in the financial market. And as a result of that, the best thing to do is tuck your money away and put it in there for the long haul. And I think if people just stuck to that, they would be very well off. But again, the discipline around saving is weak. The flip side of that coin is getting into debt is also a huge problem. People come out of school and they're $200,000 in debt for a history degree, and it takes them 20 years to pay off the student debt, which means they've wasted 20 years of time investing. They can't even get to zero. They start out at negative 200, and then they buy a car, and it's 25, so now they're at negative 225. And then they, get married and buy a house, a $400,000 house, so now it's negative 600. How long does it take you to dig back to zero when you're at negative 600 grand? It takes a long time. And so those people get hurt because they don't start investing early enough. And so they lose the time value of money. Albert Einstein was a smart dude, apparently, right? He said that like the eighth wonder of the world was this power of compounding interest. And if a guy like Albert Einstein could recognize the importance of just getting your money invested and let it ride, let it sit over the long term, it's going to pay off. I think too many males, and I will say this stereotypically, males tend to love to trade. They love the commission-free trading. They love the Cash App or the Robinhood app, and they can open it up, and there's a buzz around trading. That's fine. Put $1,000 in there and buzz all you want. But your big money, go tuck it away and let it ride for 30 years. You'll thank me. I guarantee the market will be higher 30 years from now than it is today, or 40 years or 50 years.
Absolutely.
So that's my, and I hate to simplify it so much and say, no, you can ignore financial theory, but really for the average person, for the average person who doesn't have a finance degree, who isn't working in the financial markets, who is doing some other career, that's the way to do it.
Yeah, I mean, absolutely. I know that, the whole concept of day trading, I think, is one of the first bits of content that I started addressing, when I got online, and just the whole point of how this really isn't a successful practice. How less than 1% of day traders make any form of profit. It was a Brazilian study conducted in the last decade that found that, less than 3% of Brazilian day traders made more than the minimum wage. Not that they were immensely profitable. They were making a profit. They made money. And then after fees, whatever that might have been, less than 1% over any period of time are successful. And, we keep selling day trading as this massively, successful get rich, field where, again, if you subscribe to a Discord channel, you hop on a YouTube link, whatever, you go to a limited time only webinar, you'll find the secrets to day trading. And people forget how that niche, let's call it day trading in general, or quick investing, is not meant for the retail investor. At this point, 80% of trade volume in the markets today are algorithms. Are these major banks, Morgan Stanley, Goldman Sachs, trading back and forth in nanoseconds, if not sooner. So trying to make quick second decisions, placing a trade in 1 second, the next sitting 2 minutes later, for the average retail investor, this system isn't built for you. Because the guy that you're...
Well, and it's not investing. That's clearly just speculating. I read a book one time. It was How to Make a Small Fortune in Day Trading. And I opened the book, and page 1 said, start with a large fortune. And page 2 was the end. Because that's the bottom line. Most people get wiped out. And I really, if you look at even just this bear market, this was not a nasty bear market that went down 60% like we saw in 2008 or 40%. This was so far, it was a down 20, 25% bear. We may not be out of the woods yet, but down 25 is a typical drawdown. You typically have a drawdown like that once every 3 or 4 years, 5 years. But yet it wiped out many of the stomp traders, those who were buying the memes. And, I think it's cool that there's a group of people who are so interested in the market and have kind of rallied behind some of these famous name companies. But this is just a momentum play. In 5 years, I don't expect the companies that are meme stonks today to even exist. Look at what's happened with Peloton and how it zoomed to the moon because everybody was going to go buy an exercise bike and ride like hell during the pandemic when they were stuck at home. And now those Pelotons are awesome clothes hangers because I guarantee the only thing that's on that Peloton is a shirt you wore last night to the bar and you just swung it over when you rolled in, right? It's a place to get that the jacket, right? So these things, but this is very predictable. This has happened in the past. So looking to the history to understand what's happening today is really important. And for a young person who says, "Look, I wasn't alive. I wasn't born in such and such a time." This is where reading history and understanding the stock traders almanac and things like that can really come into play. You can understand how markets behave because look, humankind has been around for millennia. And behaviors don't change. Toilet paper goes on sale, and what does mom and dad do? They go out and buy a truckload of toilet paper, right? Stocks go on sale. What do mom and dad do? They sell everything because they're in panic, because they're scared to death. Yet toilet paper was on sale, they bought. Stocks are on sale, they sell. Why the difference? This is psychological and behavioral finance. And if we can understand those biases, we can be better. If we know that men on average trade more frequently than women, maybe we should delete that trading app on our phone or only put $1,000 in the account that we can get to easily to trade with so that we don't blow up our retirement, our life savings. There's some steps we can take to maybe be better investors. And so my goal is to share, when I teach a class and so forth, is to share those experiences and to share the trials and tribulations and mistakes that I've made so that people don't make the same mistake, because certainly we can learn from our mistakes.
Absolutely, and I think that's the goal of academia, the goal of education in general, is to not just teach someone else a thing, but teach them how to not make the mistakes that you've made. Because admittedly, even being 23, before I got here, I think I blew up 2 separate trading accounts when I was like 14 and then again at 18. I had to learn some lessons by failing, and those were very expensive lessons, probably the best lessons I've ever learned in the markets. And that really formed my own decision making and allowed me to be even despite being at a relatively young age, I like to think, more mature, having been now in the markets for about a third of my life. About 8 years investing in them, talking about them, and having that experience where now, having read history, tried to learn about what happened in the past. I think one of the most dangerous phrases in all of mankind's dictionary is "this time it'll be different." Yeah,
it never is.
It never is.
History doesn't repeat, but it does rhyme. And so I think back of the 1998, 1999, 2000, the dot-com cycle. Everybody had their spreadsheet. The first thing they do when they get in is they'd open up their spreadsheet and they'd enter the stock price because the stock had gone up the night before. And, you didn't get always the same day results. It took a day to get the, yesterday's stock price. And you'd update the spreadsheet. Well, I'm this close to, doing whatever, retiring or whatever it was. And everybody would get their information from message boards. And there were, just like you've got Reddit today, you had very similar kinds of things. And, of course, every third message was from a swindler trying to sell you something. It looks very much the same, very, very similar. Now, what's interesting is go back 100 years, okay, not to 2000. Go back to 1921, 1922, 1923, and read some history about some of the swindles, some of the investing, quote-unquote, ideas that happened 100 years ago, leading up to the Great Depression. It is remarkably similar to what you read about today. Remarkably. Real estate in Florida, swampland in Florida, real estate market that was going crazy, and all these different kinds. In fact, Ponzi himself created the Ponzi scheme in this time period, if I remember right.
1920 in Boston, yep.
That's right. So I think it's important to be an absorber of history if you want to be a good market observer, because human behavior repeats, history tends to repeat, or at least rhyme. I think we can learn a lot from that.
Yeah, absolutely. I know I want to be cognizant of your time. So in the little bit of time that we have left, I want to discuss
Sure.
some general market commentary analysis, because we've brought up the point of things being on sale. And I know that a month or two ago, on our different LinkedIns, we had put up our projections for where these markets go. And you were significantly more optimistic than I was. I believe your bottom was around 3,200 on the S&P, with us ending year at 3,500. Was that roughly accurate?
That's right. Yeah, that was the forecast.
And I remember around that same time, you had most of these major banks also downwardly forecasting their projections to most of them around 2,900, 3,000 at their bottoms. And then there was me, who had a projection for the S&P at 2,400. I was feeling very concerned with that until Professor Nouriel Roubini himself came out and was like, I actually see a 50% drop from here. I felt better at that point, because suddenly I wasn't the only guy in the room who was screaming about major economic recessions. I think his direct quote was, anyone expecting a mild recession was, quote, delusional. He's expecting a major financial crisis and debt crisis. But really looking at what's happening in the economy, because in recent days, really, let's say weeks or months, we've had discussions on the GDP, especially when it was announced a week or two ago, and we were in a technical recession. I think it was the first time that GDP really entered the common vernacular in a while. And so when we're looking at economic measures, another one that's been touted a lot in financial circles the last few months has been the yield curve. The projection of bonds trading in a shorter-term time frame and a longer-term time frame, and how when yield curves invert, generally speaking, going back 55, 56 years, whenever those yield curves invert, the 2-year and the 10-year, it hasn't been wrong, especially after a prolonged period of time. The yield curve at this point has been inverted for more than a month, close to 2 months consistently now, and it's a very deep inversion at this point. So people are discussing, at this point, people saying we're not going to have a recession at all. The next bull market has already begun. And it's at that point where I personally take a step back and I go, I understand that there will be another great bull market. We will have one. But I don't think that we've seen a recession yet. I don't think that we've seen that true bottom of a bear market. That's also why I've stopped turning on most financial news broadcasts, because every other day someone's coming on and saying, all right, we've hit bottom to the moon. And I go, well, economically, I don't know if I can agree with you unless we throw out the book on history, on yield curves inverting, on oil, the price of crude oil doubling within a 12-month span. We can't just assume that things are going to magically get better. And valuations at this point are still absurd. I think that a lot of people are referring to it either as irrational exuberance. I think I've called it a drug-induced euphoria at this point, where valuations for companies are extremely divorced from their earnings, from how they actually function as companies instead of just as ideas. Where in the 1920s, the average S&P 500 listed company had a lifespan of around 67 years. As of 2014, the average lifespan was 15 years. And in that same period of time, we've seen the PE ratio, the price to earnings ratio, a measurement of how expensive a stock is compared to its earnings, exponentially increase from an average of 15 all time to, since 1990, 25. We've seen companies begin to trade exponentially above what their earnings are, where we've, bringing back Warren Buffett, kind of forgotten the point of value investing. That's kind of gone away. And one of the indicators that I look at that is largely unspoken of outside of value investors is the Wilshire 5000 to GDP ratio. The Wilshire 5000, full disclosure, is my favorite market index because it has about 3,800 companies in it, so it's much broader experience. It's basically every company in the market. And it has a ratio, which is essentially called the Warren Buffett indicator because of an interview he gave back in 2001 where he called it the best measure of value, where that ratio is the value of that index divided by the GDP of the company, the economic output of the company. It should show us how companies are valued based on how the economy is doing. In a perfect world, when things are equally balanced, it should be at 1, a 1-to-1 ratio. Back in 2000, that ratio was about 1.18, and it bottomed at 1.65. In 2007, it peaked at 1.12, it bottomed at 0.56. As of today, the Wilshire 5000 to GDP ratio is 2.13. So whenever I hear people say that we're on sale, relative to 6 months ago, perhaps, at that point the ratio is 2.5. But to say that things are undervalued or even fairly valued still seems egregious to me when we're 2 times above what fair value should be. So, looking at things economically, I just don't see how price levels at this point make sense in a long-term scale.
Well, so I think there's a couple things that are different about some of the indicators. I think you have to take them with a grain of salt because interest rates are still, even after 2 Fed hikes, 3 Fed hikes, historically low. If you look at an interest rate graph and you look at where interest rates came from the highs in 1980, 1981 to where they bottomed out in 2021, that's a 41-year run of rates that were lower and lower and lower and lower. And so I think you have to take valuation with a grain of salt with historically low rates. We may see multiples that are more like 19 or 20 rather than 15 or 16. And so, the market was due for a correction. We saw more than a correction. We saw a bit of a bear. It's anyone's guess whether we're done yet. I'm more in the bear camp. I like to believe that we have some more excess to work through. We're still seeing meme stonks with weird valuation coming from nowhere. And once you've had capitulation, you don't see that any longer. We have moral hazard. We have crypto going bonkers. We haven't worked through this yet. I think we worked through the first phase. But what happens if inflation stalls and we can't get it below 8%? What happens then? What moves does the Fed have to make? Well, the Fed may have to go a full point or 1.5. We just don't know. So I'm cautious here, but my perspective is I smell bullshit. And I don't know if it's on my shoe or if I walked past it, but I smell bullshit. And when I smell bullshit, I trust my instinct. And that's what I'm doing here is I'm trusting my gut, my instinct. The data isn't lining up between earnings and inflation and the global economy where China is having to drop interest rates, where supply chains are continually disrupted, where Europe is likely to be freezing and everybody wrapped in blankets this winter because of oil embargoes or not, natural gas not being able to flow into Europe. So that I worry that I'm just a little bit ahead of the market in terms of what I'm seeing and what I'm thinking. That oftentimes is the case. Is the market really that smart? I don't think so. Not necessarily. Sometimes it takes the market a while to figure things out. That COVID was happening in China since November of 2019. Okay? It wasn't until March of 2020 that the market caught on that there was something going on. 5 months. So this is one of those situations where I think the market has seen one or two reports of good news on inflation, and it's like they're partying like it's 1999. I don't buy it. But I tend to be professionally skeptical. I tend to be a skeptic because as a finance person, you tend to question things. You tend to ask why. You tend to not believe the salesman when they come and sell you something. You tend to not buy in. And so I'm not buying in. I don't think we've got our handle on inflation, especially if oil remains elevated, because that's one of the most important input costs. I think the supply chain is going to be disrupted for a long time, because even if China comes back, companies are going to want to pivot out of China. They're going to want to build factories in Vietnam and in other places around the world, in North America. And it takes years to build a factory. So until the new factory is turned on, you can't automatically solve your problem. So I'm just not buying all of the good news. And so I think we're in for it. It's really hard to be a bear right now. People are throwing spitballs at me because I'm a bear and the market is at 4,300 here. So, we're only down 10, 11, 12%. We were down 21%. We've come back from 36.66 to 4,300. So that's been a nice rally. But I think we're still in a bear market. And I think we could go back down to 36.66 or test lower, to 3,500. Now, 2023 and 2024, all bets are off. I don't know what's going to happen, tomorrow, let alone 2 years from now. But I'm pretty cautious. I'm pretty conservative here. Now, that doesn't mean you take all your money out of the market and stick it under a mattress. You have to manage your risk, manage your risk tolerance. A real simple rule is take your age and take 100 and subtract your age from 100. And that answer is the percentage of your total portfolio that you should be in stock. So if you're 22 years old, 23 years old, you should be 76, 77% in stock. Because you're young, you've got time on your hands. What do you care if the market goes down 20% next month? In 4 years, it's going to be right back up. And it would really be a drag if you hadn't put that money to work and it was still sitting in cash, losing 8% a year because of inflation. So understand your risk tolerance. That's really important. An old guy like me, I'm not a boomer, but I'm Gen X, so I'm the original, the OG of the next generation. I'm a little bit older, so I'm a little bit more conservative. But, I don't think anybody should ever, totally exit the market. I think that's a mistake because no one can tell what the market's going to do tomorrow, let alone long run. It's just impossible. We just don't know what weird things could happen.
Yeah, well said. And as it pertains to market analysis, as someone who is more professionally pessimistic than you are, trust me, those spitballs are a little harder and more rapidly incoming on my end. But I also, I'm watching what these major banks are telling their wealthy clients, what they're telling them to do. And that was Jamie Dimon. That news broke yesterday, was telling his ultra high net worth clients that he sees a less than 10% chance of a soft landing. 20-30% chance of a mild recession,
sure.
20-30% chance of a severe recession, and 20-30% chance of something worse. After his financial hurricane comment back in April, I didn't think he could get more cryptic. But he somehow managed to do precisely that. So with that, really watching these markets the next few months will be interesting. I know that September is a kind of month we both have highlighted for the infamous September effect with markets generally underperforming. So, we'll have that to look for. So, moving forward, with now both of us out there, where can people go to follow your work or read, anything you publish or your ideas or thoughts?
Well, I like to publish things on LinkedIn, so check me out there. That's probably the best place to catch the day-to-day commentary. Certainly take a course from me if you're interested in taking a course. We have online and in-person courses at the Kelley School of Business, so that's always an opportunity. I do some exec ed as well, which is fun. And reach out. Send me an email or a LinkedIn mail. I love to chat with people, and I love different perspectives. I'm not the smartest person out there by any stretch, and I love to get different perspectives. To be a better investor, you have to be open-minded. You have to be intellectually curious about things, the way the world works. And so, reach out. I love networking. So thanks for having me here, Gabe. That's great. Great opportunity.
Absolutely. So, anyone who wants to follow Dr. Joe Fitter on LinkedIn, he's a great follow. He's been someone that I've been following for a while. Great economic monetary research. So thank you so much for taking the time, and for everyone who's tuned in, thank you for taking the time, and I'll see you guys.